Hey, it's Tom here and welcome back to the channel. So in this video I want to talk about a topic that's probably not particularly popular to talk about, or not a topic that gets a whole lot of clicks on YouTube or anything, but I basically want to talk about building good investment habits and also building an environment around you that's kind of conducive to good long-term investing. So this is a topic that is inspired by me reading through this book, The Education of a Value Investor. I first read this book probably 2 years ago, or close to 2 years ago, I would say, and I've kind of been rereading through it the last couple of weeks. And Guy Spier talks in that book quite a bit about building a good investment environment and kind of setting up a structure in which he can behave as rationally as possible. And he talks about that from kind of two main aspects. So he talks about the way in which his fund was structured in terms of both fees and not having management fees and focusing on performance fees only, and also around not having a structure in which people can kind of redeem their money really quickly, kind of changing the structure of his fund to where he only has annual redemption and doesn't have to, constantly worry about people ripping money out of the fund or anything like that. And he also talks about it from the aspect of kind of being stuck in the New York and Wall Street vortex, and eventually kind of picking up and moving off to Zurich and setting up in a much more kind of quiet, detached from Wall Street kind of place in the world, and creating what he calls his own version of Omaha. And to me, the reason that these are such important topics is because in order to be as good a long-term investor as possible, I think it's important to be as rational as possible. So as much as we try to be rational creatures, we are human beings at the end of the day. We do sometimes get caught up in fear and greed and so on. But there are some kind of structural and environmental sort of things we can put in place in order to optimize our focus as long-term investors and not get kind of pulled away from the task at hand and not kind of get in the way of long-term compounding. So in this video, I want to kind of take some of those learnings from Guy Spier's book around structural things that you can put in place with your investments, and also just straight out habits and kind of environmental things you can put in place as well. And I want to share how I have applied them to my own investing. And I'm going to try and make these as sort of practical as possible and as applicable to everyone as possible. If you think there's anything obvious that I've missed or things that you've personally put in place, definitely let me know down in the comments below as well. But without further ado, let's get straight into the video. Now, firstly, I want to talk about some of the structural things I've put in place. And just like Guy Spier has focused on, changing some of the rules in his fund to only have annual redemptions and not allowing investors to pull money out next week or anything crazy like that, and allowing them to kind of focus on the task at hand, which is sort of resilient wealth creation, I guess, as someone like William Green would describe it. I think there's some similar things that you can do as an individual investor as well. So these are some of the things that I've put in place, and to many of you, I'm sure these are things that you've already got in place as well, but I think they are very, very important ones to talk about, and I don't think you can talk about them too much. So I'm going to cover them again in this video. Now, in terms of structural things that I have in place with my investment portfolio, really the big one is that I never ever want to be in a position where I am a forced seller of stocks. So for that reason, I only invest money that I really have no short or medium term need for. I can genuinely say, hand on heart, that any money that I put into the stock market is money that I don't need for several years. If I were to lose my job or something like that, I have money to live on. If the stock market goes down 50%, that's not going to keep me awake at night. And if my investments kind of get slashed in half in the short term or anything like that, that is not money that I need tomorrow. And it's not going to force me to liquidate stocks at really bargain basement prices at the exact time when I should be buying stocks, in order to pay day-to-day bills or anything like that. And for the same reason, I don't personally use any debt when I invest in stock markets either. I think debt can make a lot of sense in certain types of investments, especially things like real estate. But when it comes to stock market investments where market prices are very, very volatile, particularly in the short term, and if prices go down too much, you can be forced to get margin calls and sell out of stocks and so on. I don't ever want to be at the risk of kind of getting margin calls and being forced to sell stocks at unreasonable prices. because those are the types of things that can be very, very hazardous to your financial health. And a few months back I made a video on Rick Guerin, who was one of the investors listed in the famous speech Super Investors of Graham and Doddsville by Warren Buffett, and he was actually the investor in that speech that had the best track record. And Rick Guerin had the best track record because he was taking on margin and he was using debt to invest. But when we got to the stock market crash of the 1970s, the early 1970s, Rick Guerin was forced to sell Berkshire Hathaway shares at, I think, sub $100 a share. And those same shares are now trading for like $400,000 plus. So that is never a situation that I want to get into. So that is the main kind of structural thing that I've put in place when it comes to allowing myself to behave as rationally as possible, kind of over the long term. The other things I've put in place are largely focused around what I would just broadly call information flow. So whether you're an investor or not, you're constantly exposed to information these days. If you have a connection to the internet, you're probably getting way more information than one person can ever reasonably process each day, and I'm kind of no exception to that. So there are some things that I've put in place in order to make sure that I don't behave irrationally as kind of new information comes in about the companies in my portfolio or about the market more broadly. And this information flow can come in kind of two different forms. So the first one is literally, information like I describe about individual companies or about, the stock market is crashing like you see in financial media all the time. And it can also come just straight up from stock prices. So I know that one of the things Guy Spear has more recently put in place is he tries to not check stock prices very frequently at all. I've been experimenting with that here and there. I personally don't think that's all that bad for me to be checking stock prices more frequently. I kind of just like to have a finger on the pulse, and I don't like, it doesn't affect my day if I wake up and a stock that I own is down 10% or something. Like it doesn't affect me. I know for some people it does, and maybe for that reason you only want to check stock prices once a week or once a month or maybe even once a year. I don't quite know, but that certainly might be something to consider for yourself. So when it comes to information flow on companies, this is really what I've narrowed it down to. And over the last maybe year or so, I've really added a lot of clarity around how I approach this. So let me list out kind of what I do and give you a few examples of how I approach it as well. So the first thing is that I don't watch CNBC. That might sound like a bit of a random thing to say, but I try to pay basically no attention to financial media. Maybe if something really crazy is going on, like, we had the Evergrande news, for example, a couple of weeks ago, which looked like a genuine big threat. Maybe that's something I'll spend a few minutes kind of looking at, but for the most part, I really don't pay much attention to financial media, and I really pay zero attention to like analysts that go on TV or that release reports or anything that are upgrading or downgrading stocks. I just kind of think back to stocks like Apple or Amazon or Microsoft or Monster Beverage or anything like that, and I think about, those are some of the best performing stocks of the last 20 years. And I wonder how many times some analyst has come out and either upgraded or downgraded that stock over the last 20 years. I'd imagine for some of those companies it might be as often as like once a week or once every couple of weeks or something, maybe even more frequently, I don't quite know. But nonetheless, you would have done very, very well to just basically completely ignore what those people are saying. Because at the end of the day, it's really your own analysis, your own understanding of the company, and your own kind of conviction on that particular situation that should really drive the decisions you make in your portfolio. So really there are only two main bits of information when it comes to portfolio companies that I really pay attention to. The first one is basically just straight up company documents. So with most public companies, particularly in the US, you can go on their investor relations page, and for the most part you can subscribe to any news and press releases that come out. So if a company releases a new SEC filing or a quarterly report or an annual report, that hits my inbox, and that's something that I am most definitely paying attention to. And just sticking to that core kind of source information is a really nice way for me to just filter out all the analyst upgrades and downgrades and financial media traders and all sorts of stuff that I really don't need to pay attention to. So that's the first thing I do. The second thing that I do for each company is I literally have like a Google alert set up. So for something like Alibaba, for example, I have a Alibaba Google News alert set up, and I have it structured to just email me once a week with the top stories on Alibaba. And in the email that I get each week on all the companies that I'm invested in or that might be on my watch list, probably 90+% of those articles, I'm just scrolling straight past, reading the headlines and saying that it's, unimportant and I really don't need to pay attention to it. And the reason that I discard so much of that is because for most companies, there are really at most maybe a handful of factors that really drive that business. So if you're investing in Facebook, for example, maybe you're looking at Facebook's user growth, their average revenue per user, maybe some of the costs that the business has, maybe you're paying attention to management as well. And outside of that, not a whole lot really matters. Those are kind of the core things that are going to drive the business over the long term. So if you have a story come out on a different topic, for the most part, you can kind of discard a lot of those things. So for each of the businesses that I do have in my portfolio, I've got a lot of clarity on the things that I really do need to pay attention to. So again, let's just use Alibaba as an example. I guess I have a core kind of thesis on that investment. I think the business is going to grow at a certain rate, and I think it can sustain that growth for a long period of time. But there are a couple of kind of things that if they came up, they would be big red flags for me. So on that list is basically, is there ever going to be an issue with the VIE structure? So when you're buying into Alibaba, you're not actually buying shares, you're buying ADRs in a Cayman Islands entity. So if anything were to happen with that, that's certainly something I would lock onto and pay attention to. The other thing is any sort of pledges or donations that Alibaba have been making, which is one I'm also keeping an eye on, and also just the underlying growth of the business. So, I kind of expect Alibaba to grow at maybe low to mid-teens, perhaps even a little bit more over time. So as financial updates come out about Alibaba, I'm kind of just checking in to make sure they're still on track with that target. And also for each of these businesses, I have kind of prices in mind around the actual stock as well. So I have prices at which I would maybe buy more of the company. For the most part, with companies in my portfolio right now, I'm not really actively buying or selling anything. I've kind of got the allocations that I want to each position. So stock prices would have to move pretty dramatically for anything really to change. But there are prices that I have in mind. And if I look at my portfolio right now, there's really nothing I'm interested in buying more of unless cash continues to come in and prices kind of stay down. So if prices go down, that's kind of just noise that I completely ignore. If prices go up, there's probably one, maybe two stocks that if they doubled from current prices, I might be interested in selling. So unless anything that dramatic is happening with the actual price of the stock, again, for the most part, that's just noise to me. So that's really it for this video, and just kind of an example of some of the structural things and kind of habits that I've put in place. I found that, just investing money that you don't need for a long time is going to be very, very useful for me to behave more rationally, and kind of just having a very clear picture of the things I need to pay attention to when it comes to company news and press releases and financial updates, and also whether I need to even bother paying attention to stock movements up or down. Having really good clarity on that for each company in my portfolio is also something that I find very useful. So that is really it for me for this one. If there's any kind of habits you've put in place or any structures you've put in place to help yourself behave more rationally when it comes to investing as well, I'd definitely be keen to hear that down in the comment section below also. But like I say, that's it for me for this one, and I will see you in the next video. Cheers.